All right, hello everyone. Today we are going to dive into a tool that is, and I mean this, absolutely fundamental for any future business leader. And that's you. We're talking about the trial balance. Now, I want you to understand this isn't just about learning some accounting procedure. It's about grasping how an organization proves its financial data is even reliable enough to base those multi-million-dollar decisions on.
So let's just kick things off with a really practical question. I want you to picture a company, say a big retailer like Target, or even a major hospital. They are processing thousands, maybe even millions of transactions every single day. Now, with that insane volume of financial data flying around, how in the world did the business even begin to check its work? In all that noise, where do you possibly start looking for mistakes?
Well, the answer lies in this really systematic procedure that acts as a vital internal checkpoint, the trial balance. And it's so important to get this straight right now. This is not a formal financial statement you'd ever send to investors. Think of it as an internal report, a tool for the accountants and managers inside the company. It pulls all the final balances from the general ledger, which is basically the master record book for every single account, to perform a critical first test.
Okay, so what is it officially? A trial balance is pretty much what it sounds like. It's a complete list of every single account a company has on its books. We're talking everything from cash and equipment to sales revenue and salaries expense. And you list them along with the final balance in each of those accounts at a specific point in time. Then those balances get sorted into one of two columns, a debit column or a credit column. It's really the first big picture snapshot of all your accounts, all laid out together for review.
All right, so now that we know what it is, let's actually roll up our sleeves and see how you build one. This isn't some kind of accounting magic. It's a very logical, step-by-step process that flows directly from the core principles of double-entry accounting that we've been talking about. The whole process is actually pretty straightforward. Step 1, you literally just list every single account from your general ledger that has a balance. Step 2, you take each account's final balance and you place it in the correct column. And this goes back to what we call the normal balance of an account. Remember, assets and expenses, they increase with debits, so their normal home is in the debit column. On the flip side, liabilities, equity, and revenues increase with credits, so they belong in the credit column. And then you get to steps 3 and 4, and this is the moment of truth. You add up the entire debit column, and then you add up the entire credit column.
Okay, take a look at this example with me. You see cash right there at the top? Well, cash is an asset, so its balance is sitting right there in the debit column, exactly where it should be. Now let your eyes travel down to accounts payable. That's a liability, right? It's money we owe somebody. And yep, its balance is correctly placed in the credit column. You follow this same logic for every single account and then look at the very bottom. You see that? The totals for both the debit and the credit columns match. They are exactly the same. That is the goal. It's our first big sign that our accounting system is in balance.
And what we're seeing here is the golden rule, the fundamental law of double-entry accounting in action. This isn't just a nice idea, it's a mathematical necessity. For our system to work, the debits have to equal the credits, and the trial balance is our first real chance to zoom out and confirm this rule holds true across all the transactions for a period. When those totals match, it's a very strong indicator that our basic accounting equation, assets equal liabilities plus equity, is mathematically sound. The whole financial story, at least from 30,000 feet, makes sense.
So, the columns match. Great. Job done, books are perfect, we can all go home, right? Well, not so fast. And I'm telling you, this is the moment that separates a simple bookkeeper from a sharp financial analyst. This is what separates a good manager from a great one. Understanding the limitations of this tool is just as crucial as knowing how to make one, because a balanced trial balance can be really, really deceptive.
Let's really pause and think about this for a second. Let me put you in the manager's seat. Your accountant comes into your office, slides a perfectly balanced trial balance across your desk, and says, "The books are balanced." You were just about to sign off on a multi-million-dollar purchase of new inventory based on the cash position you see in these numbers. Do you sign it, 100% confident that every single number is perfect? The answer, and this might surprise some of you, is an absolute, unequivocal no.
So what does a balanced trial balance actually confirm? It confirms one thing and one thing only: that for every dollar of debits we put into the system, an equal dollar of credits was also put in. It confirms mathematical equality. That is it. What it can do, though, is hide huge decision-altering errors because it does not guarantee transactional accuracy. In other words, it doesn't prove that we used the right accounts or that the transactions actually reflect what really happened in the business. Okay, so let's get really specific here.
If a trial balance can look absolutely perfect, but still be hiding some major flaws, what kind of expensive mistakes could be lurking right under the surface? As a future manager or business owner, you have to learn to be a detective, and these are the exact kinds of clues you need to be looking for.
Let's break down these classic hidden errors, because you will see these. First up, a transaction was just completely missed. Imagine your company makes a huge $50,000 sale on the last day of the month, but in the chaos, it just never gets recorded. Guess what? Your trial balance will still balance perfectly because you added 0 debits and 0 credits. But what's the business impact? Your revenue is now massively understated. You think you had a weak month. You might decide to delay a key expansion plan based on that bad data. Okay, second one, an entry gets posted twice. That same $50,000 sale is accidentally entered 2 times. Again, the trial balance will be in perfect balance. But now, your cash and revenue are hugely overstated. You think you have all this extra cash to spend that you don't actually have, and that could lead you right into a cash flow crisis. And finally, and honestly, this one happens all the time, an entry is posted to the wrong account. Let's say you paid $20,000 for a big advertising campaign, that's an expense, but the accountant accidentally debited office equipment, which is an asset. The debits and credits are equal, so the trial balance looks fine, but you've just made your company look way more profitable and asset-rich than it really is, totally distorting how you see your own performance.
Here's probably the best way to think about it. A trial balance is like a spell checker. It's great at telling you if you've typed a word that doesn't exist, like accident, but it has no idea if you've used the wrong real word. It can't tell you that you wrote, "I want to go to the store," when you really meant, "I want to go to the store." It checks the grammar of accounting, the mathematical rules, but it cannot check the story, the actual business context and correctness of what you recorded. And as managers, we make decisions based on the story the numbers are telling us.
So, for your future careers, whether you end up in management, finance, marketing, whatever, here is the #1 mistake I want you to avoid: complacency. It's this dangerous assumption that a balanced trial balance means the numbers are right and all the work is finished. A truly great manager knows this isn't the finish line, it's just the starting gun for the real analysis.
Now, let me be perfectly clear. The trial balance is an absolutely essential, 100% non-negotiable step in the accounting process. It is a powerful diagnostic tool. It confirms your entire accounting system is mathematically sound. Think of it like this. It's the process of certifying that the foundation of your house is solid and level. You have to do that first. But only after you've confirmed the foundation is good can you start the real work of building the walls and the roof, the deeper analysis that leads to financial statements you can actually trust.
And so, this all leaves us with a critical, forward-looking question, doesn't it? If the trial balance is just our first checkpoint, what comes next? How do we actually go about finding and fixing all those hidden errors we just talked about? How do we get from this mathematically balanced list to truly accurate financial statements, like an income statement and a balance sheet that we can confidently use to run a business and make smart decisions? Well, that is precisely where we're headed next in our journey.